I'm Christopher Brown. I'm the program manager for the Big E program at DBJ, which is focused on helping to build the entrepreneurship ecosystem or innovation ecosystem in Jamaica. And this particular project is one that is supported by the Inter-American Development Bank and the European Union. And it just demonstrates the government of Jamaica's intent to facilitate economic development through entrepreneurial transformation. And one of the things we've realized in working with entrepreneurs is that information isn't available for everyone. So we've put this webinar together to really try and share as much information to our entrepreneurs, whether you're just starting a business, whether you've been in business for some time, whether you want to get into business, and just try and educate the masses as to what entrepreneurship is like and different aspects of entrepreneurship. So with me today, I have three panelists who will be able to carry us through the topic of valuation. I have Kevin Donaldson, who is the CEO for Roots Financial. And a bit after, I'll ask Kevin to tell you what Roots is all about. I have Ricardo Allen, the CEO of One-on-One Educational Services Limited. And I'll let him talk to you about his journey in how that business started and how we've been able to raise funding throughout the time he's been here. And then I have Cherie Williams, the CEO of Vehicle, who I will also ask to just talk to us about that journey of really trying to raise capital. So welcome, lady and gentlemen.
Thank you.
Thank you.
Excellent. All right, so Kevin, let me start with you. Can you just let the audience, us all know about Roots Financial? I know you have some background in the financial industry, but Roots seems to be something, a spin-off from where you were, right? So talk to us about Roots.
All right, Chris, thank you. Greetings, everyone. Roots is an advisory firm and a private equity investor. We invested in 5 sectors that we think represent the root of any growing economy. So that's basically what we are doing. We are invested in health, real estate and related industry, food, technology, and logistics. That's basically what Roots does. We support businesses and business ideas and bring them to the next level. We have 24 months to turn around any entity that we invest in and get them listable. That's our goal, and we have our advisory side. So that's Roots in a nutshell.
Excellent, excellent. Ricardo, can you just talk to us about your one-on-one and that journey as an entrepreneur?
Well, certainly, first of all, good morning, everyone. My name is Ricardo Allen. I started One-on-One with a dream of transforming education through making it more personalized, right? And we wanted to do that using online modalities and technologies, and we've done that. We started the business 10 years ago. Over the period, we've raised over $500 million in capital from both private investors and also the public through an IPO. And throughout that journey, we've made significant impact across the Caribbean. I mean, our software is now being used by over 250,000 users all across the Caribbean. And we continue to expand and invest in that technology. Now, one of the things that makes us unique is that when we raise this capital, usually in a case like Jamaica and the Caribbean, it's not the usual case for investors to like companies like ours, which is a heavy intangible assets. And so I'll be kind of focused, Chris, on some of the do's and don'ts of raising companies for a software company that most of our assets, we have 600 million in assets. Half of that is in IP. Right, and how do you convince an investor to invest in something that he can't see, but he can feel through the impact that we're making and through what we do in terms of our technology?
Excellent. Thank you. Thank you. Cherie, can you just introduce Vehicle and where you are in this entrepreneurial journey for raising funding and so forth? Thanks.
Sure. Thank you, Chris. So my name is Cherie Williams, and I'm the founder and CEO of Vehicle. It's a startup company here in Jamaica and across the Caribbean. And our mission is to make car renting more affordable, safer, and convenient for everyone involved. For my journey, it's been slightly different. I want to be on Chris's level one day. Ricardo's level one day. But for my journey, it's been slightly difficult. I'm still in the bootstrapping phase while still trying to raise capital. And for me, I would say it's about understanding my long-term vision, right? And understanding how much equity I need to maintain in order to achieve that vision. And so when I have conversation with investors, it's usually along the lines of wanting to maintain or achieve a lot more equity than I'm willing to give up. And so for me, it's been a journey because I understand what I'm building, I understand the potential of the company, and I'm not willing to give up too much equity early on. And so that's been my journey so far. But we'll get into the meat and potatoes.
Excellent. Thank you. Kevin, I think that's probably a good place to start. So, for example, Sherry has Vehicle, a startup tech company. She has a particular value and vision for value for her company. And I'm sure you see entrepreneurs like hers come to you who are, they have a particular vision and they're holding on to that. Can you talk as an investor how you balance the actual financials of a company versus the vision for valuation to determine an actual value, or whether some kind of transaction can take place?
Well, I think when you're looking on a startup, especially with an idea that is first to market or second to market or whatever, you can't use the traditional methods to value, right? And it becomes a qualitative exercise at some stage. But the key is for the entrepreneur to understand that who they're speaking to is here to help them. And if we're here to help you, there has to be a give and take. And you can't expect to cash out at the first fundraising round. So once we can strike that balance, then the next step is to ensure you reward the entrepreneur for the energy, the idea, and find a value that allows me to generate a rate of return that makes sense, right?
Right.
Because at the end of the day, we're taking capital and it needs to make a return. So the balance is between the entrepreneur and how you fund. Now, how do you do that? There are several ways. I have a very simple method. I take your revenue, I discount it heavily, and then I assign a multiple to that if it's a business like that. Now, I personally will not invest in something unless it is scalable. Now, if the idea is only limited to 1.5 million people, I don't want to be in that business. But if it can go to the 7 billion people in the world, that gives me more incentive to invest in it and help it to get to that point. And that's the point with tech.
Right.
The idea has to have scalability, and that's how you look at it. And it depends on the industry. So if I try to answer the question for every idea that comes here, it would be impossible.
Right,
But
right.
especially for vehicle, the idea has to have legs. Because if the business is just going to appeal to providing rental cars to the 1.5 million working people in Jamaica, then you have to discount how many of that have cars already. And then how many tourists come to the country already that go and go through the traditional means of just renting a car when they buy the ticket.
Right.
And then you have to break it down. But the vehicle now is a technology that can be replicated right across the region, and hotels can use it, and then you can find legs. That's the kind of idea that you have to build into it. And that's what I'm saying to entrepreneurs. If you focus only on the small pond, it's going to be very difficult for you to get a valuation that reflects international standards. But if the idea has scalability and you present it in that way, then you have an opportunity. So if I was advising anybody, build your plan. One of the things that Ricardo did very early when he was building out his idea, he made it clear that Jamaica was not where he was going to stop. And that is how you as an entrepreneur has to present the idea. And once we can establish that this is grounded in fact, you'll get a value that is fair to you. So I guess in summary, start out with humility, start out with understanding that I'm here to help you to get to your target, and then we can ground that in some reality and some factual numbers that exist out there.
I appreciate that perspective, Kevin, because I think a lot of the entrepreneurs that are out there are thinking that the investors just want to come and take, when the truth is that the investors want to help to build, because that is how they
Make the money.
make the money, right? And there's often this two different sides, that's the narrative that's out there, right? That investors are bad, but it's them you want to raise the money from.
Well, Chris, the reality is if an investor going to give you money to make 15%, you better put it somewhere else, because that is safer and easier to realize. When he invests in you, he expects to make 110 times his money. So he wants to have an idea that can do that. And that's why he's investing in you. He's not investing to make small returns.
Right, right. And I think that's a takeaway I'd want the entrepreneurs to have, that the investors are looking to partner with you so they can earn, and consider that there are other assets that they could put money in which could be much easier, but they are doing this because they see, or you need to demonstrate that there is this tremendous value that will come from your business to be able to raise investment. Ricardo, Kevin touched on, I guess, a bit of your journey in raising capital. Can you just talk about, I don't know, how you raised the first or the second or the third? How many times you've raised money now?
Quite a number of times, Chris. And I want more as well. Right? Education is big, and we have to spend on education. Let me tell you, Chris, we started the business 2013. At the time, it was an idea, a very powerful idea. Our idea at the time is that we wanted to figure out how could we make learning more personalized for an individual student. Ultimately, if we could achieve that, then we certainly could give every child in the world a personal tutor. And so we set out on a journey. At the time, we felt like we needed 20 million. My co-founder at the time said that, boy, we only need $1 million. I tell him $1 million won't help us. We got 5 million. How we got the 5 million? Now, at those times, back in 2013, not so long ago, we had these, for example, thumb drive that we kind of load our business plan on.
Floppy disk? You
But,
can't
no,
go
wait,
back so far.
So we had the thumb drive, and we had our business plan, and it was a little meaty. But what we felt was that people who have money probably won't want to look through a long document, right? And so we started making videos, and we made a video of about 3 minutes long. And we started pitching to potential investors. My first $1 million that I raised, I met someone at dinner. It was at Red Bones around the street. He said he was there. I went to meet him. I sat with him. I showed him the video. He stopped and he said he got the idea. But more importantly, what he said to me is that he believed in my ability to achieve it. And he asked me a very important question. He said, what does my bench look like? At the time, I didn't know the concept. What he really meant was that if this business is so dependent on me, what does my backup plan look like? And he was assessing all the risks at the time. I got $1 million. I used him. I went to some of his friends, told them that he invested, and he said they should too. And so that's how I raised $1 million. Subsequent to that, there were all sort of that 5 million, we call that angel investing. So that's kind of your first money that is given to you. Not given, no money is given, but you raise that capital initially. And the idea is that you use that to show some sort of traction, right? And so when we showed traction over 1 year, we would have built out the first few courses and so on, and it was going well. We raised an additional 12 million from those same set of persons at a much higher valuation, because now we've demonstrated that the thing is working. We used that money. We kind of ran out of funding. Chris, that's when we came to DBJ. We got some grant funding through the Ignite grant in 2016. And I remember when we got that money, we just signed a deal. It was worth about 500,000 US. And we didn't have the money to implement that deal. So again, we went to the bank at that time and we said, bank, here's 500,000 deal, 500,000 US. I need the money up front. And the bank gave us a loan for the value of that contract for us to implement something that, we certainly did not have the capital to do. And so what I'm trying to demonstrate is in our first 3 years, we raised equity, we got grant financing, and we also got a loan. But notice that the first money that we raised was for us to just try and fail. If we fail, that's angel investing. And then when you start showing something works and you have a contract, that sort of thing, we got debt because we had a contract that could support the debt, right? And beyond that, we started to scale. And so in scaling, we needed more money. And so we went to a Sagicor. And at the time, Kevin was on the other side, and he kind of guided us in helping us to raise that capital. But what was interesting, Chris, in raising that money is that we wanted 40 million, and we managed to get the first 20. And they said to us that I'm going to give you 20, and if you achieve these 5 things, we give you 20 more. Of course, we went to work, we achieved it, and we got more. Each time we raised money, it was at a higher and higher valuation because we were doing more and more work. So I'm saying all of this to say, and then ultimately we went IPO and we got a 2 billion valuation. But it all started there with a very risky idea, angel investing, moving to full equity, higher valuation. Now here's the take-home message that I have learned in all that process, Kevin. It's when you're raising money initially, you have to be willing to give up something because at the time, it's a risky idea. The more that risky idea becomes more concrete and tangible, realizable, you're getting customers, right? You can command a much higher valuation over time, but you can't do that up front. So here's what we did. We said to our shareholders early on, don't worry, we will give you equity initially as long as once we perform, we get it back. And so over the years, because we have performed and hit our milestones, I have gotten back the equity that I gave up initially. And so that's my advice to entrepreneurs. Don't be scared to give up initially to get the oxygen you need to live. And when you live and you become a big boy now, you can pay back. And that's the message that I would give to entrepreneurs.
Excellent. Thank you, Ricardo.
Yes.
And I guess that's one of the success stories, I think, of going through this journey of entrepreneurship and trying to negotiate how capital is raised to be able to pump back in a business. I think a key thing Ricardo said that all the entrepreneurs should take to heart is hitting your milestones. When you say you're going to do with the money that was provided to you, find all way to do it. Because not achieving those is what tends to have a negative impact on, I guess, the view of the investor, the view of the market. As entrepreneurs, you have to be committed to what you say you're going to deliver and actually deliver it.
Chris, just one thing I picked out of what Ricardo said. He listened. And he realized that the person that was in front of him wasn't trying to steal his business. He was trying to help him. And I think a lot of entrepreneurs think there's, oh, this person going to take control of my company and steal my idea. You have to, there's some level of trust that you're going to have between the investor and the founder. And you have to be able to find that balance. And that is important. And if he didn't do that, he would not be here today. And that is one of the key takeaways. You have to trust a little bit. And also remember, if you own 5% of a melon as opposed to 100% of a grape, which one going to fool you more?
Right.
So,
Yeah, thanks. Sherry, you said you didn't really get into the meat of the matter of, I guess, your value and vision and, I guess, what others may value the business. As an entrepreneur who is in the stage now of continuing to raise capital, can you talk about some of those experiences with differences? I guess ultimately it's differences in valuations, possibly, right? We can talk about that a bit.
Yeah, I think when you're in the early stages of raising capital or just starting a company, you have to be careful to not overvaluate or undervaluate, right? Because overvaluating is basically, you probably have unrealistic expectations or just unrealistic projections, and it may deter investors. They may look at you as risky, but you also have to be mindful that you can't undervaluate either, because giving up too much equity in the early stages of your company limits your control, and it also doesn't allow you to be as flexible in raising funding in future rounds. And this more speaks to the VC world of things, and not necessarily angel investing, but getting into the VC world of things, where if you give up too much equity up front, then they look at you as if, what are they going to get out of it? So you have to really be mindful of how much equity you're giving up in the start of your company, and determining what equity you are willing to give up to get those funds. And for me, I look at things beyond just the financials, because early stage companies, your financials are speculative. They're mostly projections. You don't really have actual numbers to work with, right? And so everything is projection. Projections change the next day, right? And so for me, you have to find those non-financial assets or things that can give you a higher valuation. So whether it's you have a patent, or whether it's IP, or whether it's, for me personally, having an insurance company that's already operating in nine islands, right? That gives us builds trust amongst the market, whether it's your customer base, whether it's your brand validation. So you have to find those non-financial things that can also add to your valuation, and not just looking at the financial projections that comes with starting up a company, because those are speculative results. So if an investor is only going to look at your revenues and say, oh, I'm going to do your revenues and I'm going to do this and that, that might not work for you and your company. You may see things in a different light. So you as a founder have to figure out what those non-financial things are that can add to the value of your company. And you speak to those things when you have conversations with investors, so that they understand that, yes, you know what you're talking about, right? But at the same time, I'm not saying to not build out a financial model, because that also gives investors confidence that you do know your numbers, even if it's projections, right? They want that confidence that you know your numbers, the company is going to be managed well, and you have things under control from a financial perspective. So I think it goes both ways. Financial projections, yeah, but not too relying on it, and the non-financial aspects as well in terms of coming up with that valuation.
Gotcha. Thank you. I just want to pause and remind, I guess, the audience that we are inviting questions from the chat. So please feel free to put those, and we will field them throughout the conversation, or at the end at Q&A. So feel free to just put them in there, and we'll manage them as well. Kevin, Sharice touched on these non-financial factors. You kind of mentioned it earlier, that it's not just the financials that you look at. Can you talk about some of the other elements of why you would make a decision? Is it the team? Is it, I don't know if it's the vision? Is it your friend? Is it, I don't know.
Well, the thing with me, when I started Roots, and even while I was at Sagicor, I set out to fund businesses that made sense. It didn't matter if the person was a part of the establishment or if the person came from the garrison. It didn't matter to me.
Mm-hmm.
I looked on the idea. That's the first thing. Then the second thing is the scalability. That was very important to me, because I was not interested in just supplying Jamaica.
Mm-hmm.
Anything I did had to be able to extend abroad.
Mm-hmm.
And then the third thing is the character, the team. Now, Sherry, if I can believe in you and you convince me that you're able to do what you're saying going to do, it's very likely that I won't give you a valuation, but I'll give you the money, some money. Because the person behind the idea and their commitment to it is very important. Now, some people can pretend to be committed, but there are questions that you can ask to find out their level of commitment. And there are things that you can do to find out if they are truly committed to this task. I keep referring to Ricardo because he's here. Ricardo gave up a scholarship to start one-on-one, to continue with one-on-one. A scholarship that some people jump on and think this is how they would advance themselves. But he believed in his idea, and he sacrificed other lucrative opportunities for that idea. Now, if I see an entrepreneur sacrificing everything behind his vision, and I see that the vision makes sense, I'm going to support him. So those are the qualitative things that you look for. Now, I'm not saying anybody out there
give up
your job to do this. But the truth is, that's what a lot of us have done. I remember when I was at Sagicor, Cygnus, I spoke at a Cygnus function. Those guys were at the top of their careers. And all of them left to start a company that was with zero capital and got it off the ground. And now it is one of the biggest financial entities in the region. I'm just saying, that's what I look for, that kind of level of commitment. Now, if you don't believe in your idea and you're only doing it for cash in on the junior market, people will find out that very quickly. And they will see the level of commitment. Is your spouse behind you? Is your kids involved in the business? All of those things you look on. You're going to spend some time with the founder, because I typically have about 3 different meetings, dinners, liming with the person. I like to lime, So invariably, anybody I invest in, we have one drink and I find out more about them. And that is important to me. I'm not saying it goes for everybody. I'm just telling you, I don't invest in people that I don't believe in. And that's it.
To lime too. For those who know me, they know that.
Maybe you should connect with Kevin.
I should connect with
I'll
Kevin.
have the spot for that. Sorry.
Awesome. I want to piggyback on that a little bit. Personally, I don't even believe in giving up equity. I don't believe in that method of funding for early stage companies. My preferred method is either a convertible debt or a safe agreement. And convertible debt, as you know, is just a loan that converts into equity, and the safe is just a simpler agreement for future equity. And I think as startup companies, like I said, it's speculative, right? And we want to maintain that control without having investors hounding over us every single day. We want to see our vision come to life, and we want that control to see that vision to come to life, right? And I would say, I think the equity thing is a Caribbean thing, and we need to embrace other forms of early stage funding that can really see startups not diluting as much in the early stages, so that we can be more passionate about what we're building, be more committed, so that we can see that vision come to life. So that's just my take on that.
I would say my understanding is that the investors, let's say the early ones, they don't want to take up too much equity, because at the end of the day, they don't want to run the business, right? So
Invested in who?
yeah, you're right,
Where are
right.
those investors?
No,
Why-
but
know,
what?
Chris,
Go ahead, Ricardo.
Go on, Ricardo.
So education is a tough business, right? It's also not a sexy business for a lot of people. It's one where you have this thinking or feeling that you can change the world from making people more knowledgeable, and who wants to do that every day of their life? Well, I did. I wanted to do that. And what I realized was that I had to select investors who were like-minded, meaning they were older guys, retired guys, who were just very much upset at the state of education, both here in Jamaica and the Caribbean. And they had capital, and they were willing to give that capital expecting not much return initially, knowing that education is a long-term play. Why am I saying that? It's so important to select the right people to invest in your company. Not every money that comes at you should take, right? I know it sounds, a little bad, like, you're drowning, you want the money, you want a lifeline. I get it. But my thing to you is that, if you have the right set of investors who are coming in for the right reason, they're going to give you mentorship. They're going to connect you to the right people. They're going to step in if necessary in your company, if necessary. But most importantly, you have to be willing to listen as an entrepreneur. Not a lot of us does that very well, because we are so convicted of our idea. But I had a thought. If you went behind that door and you saw a ghost and you came and told me, I'm going to listen to you. I'm going to believe you, right? These guys would have done business before, Chris. They would have done it for a very long time. And they were on my board. They were giving me advice every single day. I could call them any time of the night and get their advice. And so I got the feeling that they were not just in it for equity. They were in it to make it work. Mm-hmm. And if I had to give up something to get that, it was a small price to pay for that, because you can have all the capital in the world, but if you don't have the right people, the right team, the right guidance, I tell people we were running a public company before we became public, because these guys would have asked me to ensure that I produce monthly financials, ensure that when you take money from people, you report on how that money is doing. Very important. When DBJ gave us our grant, we had to be reporting on how we're spending the money and so on, because the reporting obligation increases. When you list the company, you have to report even more. So the point I'm making is that the art of raising capital, it's a two-side game, but what I would say to you is that if you have the right investors, it becomes easier. So the key is to select the right investors to be a part of your company.
Excellent.
Yeah,
Excellent.
I agree.
Yeah.
I wanted to touch on something. Kevin, could you outline like red flags, like things that would make you not invest in a company or consider it? As I know you touched on, clearly the positive, it have to be scalable. So if it's not scalable, you're not going to look at it. But can you identify anything that, from based on conversation, you see would just be a turn off? And Ricardo, you can chime in
Sure.
your thoughts on that.
Well, I can tell you, I don't like copycats. I tend to not invest in copycats. And it's hard for me to answer that question because I have a very finite focus. There are 5 industries I invest in, that's it.
Okay.
I advise anybody to raise money. I can advise any company to raise money, but I only invest in 5 industries.
Gotcha.
So that's the first thing. If they don't fall in the industry, I'm not going to look at it. But I think one red flag I look at, and that's why I have to spend time with the founder, is their ability to control themselves. If I see somebody that gets volatile too easily, it's a red flag. Because invariably, this business of entrepreneurship and just doing anything in general, there's going to be things that come at you and challenge you and shake a very foundation. And you have to have that willpower and drive to ride through that storm. And you can't lose your cool. It's not about, yes, you're going to have emotions towards your business, but at the end of the day, emotions does not drive the decision making behind it. So that's what I look on. I'm not interested in anybody that at the flip of a hat, they blow up on you, they go off on this tirade and throw a tantrum. So that's a big red flag for me. And why I'm talking about the qualitative things, because invariably you guys that start businesses are very brilliant and very good at what you're doing, and you think everybody else around you is stupid. And I'm not saying that's
Right.
Sherry or
Right.
Ricardo. I'm just saying that's a conceptual view of founders. And you don't like to listen. And if you can't listen, I can't invest in you. Because I have to be able to tell you when you're going wrong. And you have to be able to tell me if I'm saying something wrong to you. So those are the things that I look at. It's very qualitative for me. But in terms of the numbers now, if I see someone put out a valuation that is not reflective of the market that you're going to operate in, that's a big red flag. It means that you're trying to clone me out. I'm trying to find the right word. But it basically saying to me that you don't respect me enough to come with rational numbers. So that's one of the second things I look at. So the 2 things, the person and what they stand for and their emotional intelligence, and then how viable and rational the numbers that you present to me are. Those are the 2 things that I would jump at.
Right, Ricardo, you can
So,
contribute.
Chris, I've been recently selected now as a investor, and so I'm learning the other side now, right? Certainly, my background would have been a part of, Sagicor, where I started out. Kevin was watching my boss, but one of the things I look at, to be quite honest with you, and it's hard not to put my personal kind of background in it in terms of when I started out, is who was Ricardo when he wanted to raise money, right? I remember in 2016, this is a personal story, one-on-one, where we had racked up some taxes with the Jamaican government, and there was not a day that we didn't file. And, people said to me that, why am I filing and I don't have the money to pay? I said, well, I have 5 guys who I can't mess with their names. I was super overly ethical on my governance, my reporting, and just ensuring that while they're not there every day to see what I'm doing, I did the right things right all the time, or I try to, or if I don't know, I call them, right? And that's important. So one of the things I look at as a big red flag is the type of person you are, from a governance perspective, ethically who you are, you
So
kind
the,
of.
so the people who say them don't want a board.
Yeah, look,
No
you can have
guide-
advisors. I mean, you
advisor,
can have
okay.
advisors. The key is that, as I said to you, you want ethical people to do business with. It's so important, right? Because when you give money, you don't have the time to watch what your money do every single minute of the day. So you want to be dealing with very ethical people. Also, you want to deal with people who know the product that they're selling and they have an idea. You're not going to have everything figured out initially, but you have an idea and you can defend defend it and you can engage in a conversation about it. You know your company. And don't let the investor know more about your company than you do, right? Kind of thing. So they're investing in you. So those are two of the kind of big things I look at. What I will say too is that, when I look at companies, and they're raising money, I look at something called a burn rate. I'm not sure if we're familiar with that concept, meaning the rate at which you burn through cash if you make zero revenue, right? Kind of thing. And, is that burn rate too high to bring you to the next milestone? Because it's okay to make zero revenue when you're testing out an idea, but your burn rate has to be low enough and you keep agile enough and you keep your salary out of it, that sort of thing, to get to that point. So I kind of look at those things. And if all of those factors kind of align, because I'm starting to invest in companies and those are some of the things I look at. But I'll tell you one last thing. The level of drive and determination. I love a drive in an entrepreneur. Because you see, in the bad days, the rainy days, that's what's going to keep you going, right? When things are not going well. In 2016, I sold my cars, everything I owned. My wife had jewelry, I took those and asked her to sell it too. And I sold everything to keep my company going. How many of us are willing to put everything on the line for what we really and truly want, right? Now, many people will look at me as crazy, but in hindsight, you wouldn't, because I have done it. Many people it has not worked out for. But the level of drive is very attractive in an investor, because that's the stick-to-itiveness that you need. The first 2 years of a business is to buy 3 more years in that business. Somebody told me that 10 years ago, and it has proven true. You use the first 2 years to give you 3 more years, and then you can scale after that. And that's what happened with One-on-One. I suspect it will happen with a lot of companies.
Excellent.
Nice.
I probably just going to kind of close on this general question, which is, somebody had put it in the chat, so I'm bringing it out in terms of the different methods or ways of valuing a business. So I think we've spoken a lot about the qualitative side. I think the audience wants to understand some quantitative methods. I'll probably just start with Sherry first. As an entrepreneur, how have you gone about ascribing a value to your business?
Interesting. So I think for me, and I have an accounting background, and so for me, it starts out with understanding my market, right? Understanding my market in order to build out that financial model that can then tell the story around how the company is going to grow and expand and all of that stuff. And I find that a lot of entrepreneurs do not understand financial modeling or how to even present financial statements in a meeting and things like that. So for me, yes, I understand that level of detail. And so I build up my model from the bottom up. So understanding the market, first you have to understand, first of all, how many people are coming to the Caribbean, right? And where are they staying? What are they doing? And all of that thing. You have to understand your market. So the research upfront is important in order to start building out your financial model. And I would say that for me, the three things that I look at in terms of valuing or my business is transparency, viability, and risk, right? So transparency tells the investor, okay, is your business financially healthy, right? Viability is just looking at the various different statements, whether or not you're profitable or you have a path to profitability, looking at how much you own versus owe, and whether or not the business can sustain itself. And then risk, they look at, okay, are you over leveraged? Do you have inconsistent cash flows? So you have to understand the dynamics of your financials in order to be able to present that to investors. But in terms of valuing vehicle specifically, and it's really hard, again, because the numbers are speculative. They're projections. And so for us, we not only looked at the financial metrics, we also looked at the non-financial assets as well. Right? So whenever investors say, okay, how much are you raising? I say, I'm raising $350,000. And they say, okay, what's your valuation? I don't look at it as what's your valuation. I look at it as this is how much equity I'm willing to give up for that amount. Yes, it's going to turn into a valuation, right? But I try to steer the conversation away from a valuation. This is how much I need to raise in order to get me to the next milestone. and this is how much equity I'm willing to give up. Why? Because I understand the long-term vision of the company and what we can achieve. So that's how I look at my valuation for Vico, which may be different for other startups, right? Depending on the industry that they're in. So you have to determine what that financial and non-financial asset is and how you figure out how much equity you're willing to give up to maintain that control as well as to see your vision come to life.
Okay. Ricardo? And I know your current business has a value by market, right?
Right. No, for sure.
But you can probably take us even before that.
Yeah, I'm taking you back 10 years ago, right? Because everything kind of started there. So,
And this is just for context. I guess this would be valuing a technology company,
right.
let's say, which is an edtech company.
Right, yeah, it's an edtech company, education technology company. So, if you're valuing a company that has other companies like it, and you can kind of see how that company is valued, you can appear what's called comparables, right? So you can look at the industry, what a company like that is valued at. There are many ways to do that. You could look at the book value, or you can look at the net profits and, or cash flows, and then you apply something called a multiple. And then you said, if that's the multiple for that industry, I applied for us. When you start out a business, though, that is new, that is novel, you don't have the luxury of another company, right? So how do you do that, right? Well, you have to do your financial modeling. You have to look at your business and look at year 1, year 2, year 3. Look at price of your product times the quantity that you're going to sell. And you're going to come up with some revenue items. And then you can estimate some costs. Now, you're not going to know all your costs, but you have a fair understanding of what that looks like, right? And then you're going to do what's called a 3-year to 5-year projections. Now, I can't see beyond 5 years, so what you do beyond 5 years, you apply what's called a multiple, right? What's a multiple meaning? At year 5, how long can I sustain that level of performance into perpetuity? And so what you do is that you combine that 5 years that you've projected and beyond the 5 years, and you discount it to today, meaning what is the value today of all future cash flows that my company will generate? You can also apply some probabilities to that. So you could say, okay, here's my base case, here's if it doesn't quite work out, and here's if it really works out, right? And then you kind of average the 3, and then you come up and say, okay, this looks like the present value of all my future thing. And then based on that, you said, I want to raise 50 million. My present value is 200 million. That means 25%, 50 million gives you 25%. Now, when you do that number, what I did now is that back in 2013, I said, you know what, I don't want to give up 25% initially. So what I did is that I had some convertible pref shares. So I issued a convertible pref, got 50 million, and then allowed it to convert into 25% of the company if the valuation stayed at 200 million. But if it went to 400 million, which is twice the value before, 50 million now becomes not 25% anymore, but 12.5%. And so therefore, the first step is to value the business. This is just one way. There are many ways to value a business. Different companies, different stroke for different folks. There are companies like WhatsApp and those companies who did not generate revenues initially, Chris, but they had a large user base who you could potentially use to monetize, right? And so you can value user base as well and the potential to monetize. Again, when I start to monetize, what's the value today of that future monetization? So, my view on valuation is quite simple. I'm an actuary by training. Is looking at the future, discounting it today with probabilities. That's it. And that's how I look at value.
Kevin look like him proud of you as a student.
I hope I explained it.
Hey, guys, what I would say though is value comes down to a lot of different things. And to bridge the gap between Ricardo and Cherie and the investor, you just get somebody independent to do it. That's what I do with all my deals. I don't bother argue with I say, if you will agree with me that we can get a EY or PwC or somebody independent to value this company for you, and whatever the value is, I will pay you that. That takes out all of the guesswork, and they will use their methodology because every industry is different. What he spoke about will be applicable to a certain industry. What Cherie spoke about will be applicable to another industry. There are different methods. You have comparables, relative valuation methods. You have discounted cash flow. There's so many. You have multiples of sales. We could go through a myriad of things. And I'm saying to you as entrepreneurs, the simplest thing is get an independent valuation done. And if the person is a trusted person or a respected person, the investor invariably will trust that valuation. I'm going to discount it by probably 20% because you're liquid. Them can't sell it for days. I'm saying to you, don't get too bogged down with holding on to this view that you have of the company because your view is skewed by your mind. The investor view is going to be skeptical because they have to be. So get a middleman now to solve that problem for you. And that is my suggestion if you're at that stage. If you're a startup, my suggestion to DBJ and whatever alliances are going to be created, IDB, is create a framework for startups and small businesses to get a valuation done that investors can rely on. Because that is always going to be the contentious point. And investors just want to invest. And if they can find a simple way to get it done, they will do it. And that's so I could list a lot of things, Chris, but I don't think we have time for
No,
that.
man, agreed.
So the solution I'm suggesting is we want to create an ecosystem. Let one of the solutions that we need to put out there is a transparent way to value for persons to get independent valuations done. Probably that could be the grant funding. Get your financials done, get a modeling done. I think you already do that. And that will help investors invest easier. And it will also build up the database that you have.
Yeah, right,
And it enables this whole thing that we're trying to do in this country and in the region to be better.
Right.
So that is my
So
suggestion.
thanks for that. Because I know there is a thought, as in people look at value based on other markets as well, right? So somebody was able to raise X in Silicon Valley, somewhere in the US, in New York, etc., and then kind of apply to say I have a business that is similar, so therefore it should be similar, right? And I think that's a notion that people should
I just think
kinda-
that, honestly, when people say that to me, I say, Chief, sorry for speaking so straightforward, but you understand that it's 330 million people live in the United States. You understand that their cost of capital is far cheaper than us here in Jamaica. So there's more money chasing after things. We can't have the same valuation, no matter what your idea is. So we have to just be real. And I think that's what we need, these things, and we need the DBG and other persons to develop that kind of framework for people to transparently value their business so that investors can invest. Because there's a ton load of money in this country that needs to be deployed to support vehicle and one-on-one and roots, because I'm a fundraiser. Yeah, that's it.
All right, excellent. You want
I
to
don't
touch
think.
on-
Thanks, Kevin, for for being so transparent. But I don't think the experience that entrepreneurs that have had so far has been positive in terms of investor conversations. And so while for you it might be you look at these different things and you're looking beyond Jamaica and you don't look at things that don't scale. Even if there is a company that has the potential to scale outside of Jamaica or even the Caribbean, the investor conversation still remains the same. I've had investors who wanted 70% of my company to start, and so yes, yes, 60%, 70%, and the conversation is just not rich when it comes on to investor and entrepreneurs, and that's been the experience, unfortunately.
Yeah, thanks. All right, so I'm going to there are some questions in the chat that I'll just field as I see them here. Well, there was one around different valuation methods for edtech companies. I think we touched on that. So there's a question here. What's the appetite of the market for a company that is about 4 to 5 years old, that has grown slowly over the last 4 years, but for this year, the year to come, is expected to do 250 million, I'm assuming that's J, in revenue, but they've only showed this type of revenue for 1 year. Is it too early for the public market? Or I guess their thoughts around strategies, around what they should do in terms of raising funding, given that they are expected to do a good first year and trying to figure out what the next 2, 3 years look like. Kevin, I don't know if you want to tackle that.
Well,
And
Ricardo, look like you're ready, but let me tell you this. I am not an advocate for running to the public markets. I just being very straightforward. I'm not an advocate. I think companies should spend some time soundproofing their model and making sure that it's sustainable. So yeah, you do it 1 year. What you going to do next year? What are the plans to ensure that that happens in the coming years? So I don't know what industry that company is. I don't know what the size of the market is. But what I would say is 1 year, a one-hit wonder is not a listable prospect.
I think I know. I think it's real estate. Anyway,
What I would say is that a one-hit wonder is not a listable property. Yes, it might can list because I just share this with everybody here. What the Jamaican market is going through is what every developed market went through in terms of we came up with this idea to list companies quickly and invariably companies failed and all of that. That happened in the States, that happened in Toronto, that happened in Europe, it happened right across the world because everybody thought that quick way to get some easy money. But that is not a sustainable thing. You have to have a business model that can weather shocks. You have to have a business model that has a strategy that will continue on this continuum to grow. And that is what you have to demonstrate to the market to become listable. It's not just generating 250 million. It has to be something that is sustainable. And then there's legs to go up further. That is how you look on, that's how I invest. I'm not going to invest in something because you did 250 this year. That's gone already. What are you going to do next year and the year after because I'm investing for a 10-year cycle. So that's how I look on it.
Right. Ricardo, you want to touch on?
No, just quickly. I think, we, again, started the company 2013. We wanted to list by 2016. And, I laugh at that when I look back because, again, first 2 years is
Well, if you think about it, sorry to cut, like that got to a point in Jamaica, and I think it kind of still is that. That's the goal people have in the next 3 to 5 years to list on the junior stock exchange or the stock exchange, right? So you're a product of your environment, right?
Look, let me just say, I applaud anyone for that sort of thinking. It's good to be ambitious. What I would say is that the process to list and even listing, Kevin, you mentioned it. Listing a company is one thing. Running a publicly listed company sometimes takes you away from being an entrepreneur. So if you're thinking about listing, don't just look at the money. There's a lot that comes with it, right? I mean, look, I am in my studios, building out, and I'm sitting on the floor with my team members, and I get called into a meeting that I don't want to be a part of, but it's important because you're a listed company. The point I'm making is that 3 years to list a company, 1 year worth of strong performance is probably not good enough, right? You want to show a track record of performance. You want to show credibility in those numbers so that when you do a valuation for the investing public, they can believe in it and they can invest in it with some amount of confidence. Shocks, you have to be able to weather shocks. So I don't want you to make 250 this year and then next year you're down back to 50. The volatility is not good, right? So yeah, I would ask that person to just kind of take that 250, get some private equity. And the private equity, you can raise it. So before I raise the public funds, the IPO, just quickly, I did a round, and the round was a non-valuation round. What I said to an investor was, it was a company, I said, I need $75 million, but the value of that $75 million will be determined at my next funding round. Meaning the next time I raise money, depending on what that valuation is, I'm going to convert that money into that round. What that allowed me to do was to take 75 million, build my value so that that 75 million is worth less in terms of a percentage value.
Right, gotcha.
So that's a strategy.
Another question I see. Thank you, gentlemen. This one is for you, Kevin. How do you value a business with no comparables? For example, how did you value Edifocal before investing?
No, I didn't need to value Edifocal before investing. I gave them a loan that was convertible at IPO. So that there was no valuation necessary. But to answer the question, it comes down to the numbers. You use a benchmark based on, because the company must exist somewhere else in the world, type of company. You look on those comparables, and then you discount it for your environment. That's what I do. But invariably, what things come down to, it comes down to the numbers that you state. And then I'm going to discount it, and then we'll agree or disagree. But that's how I value companies. If you tell me you want 50 million at a 25% valuation, I go and look on your numbers, and if it makes sense to me, I'll give you your money. But if it don't, I'm going to make an offer. That's how I look at it. If there is no comparable or there's no reasonable guide out there, it has to come down to a gut check. And I'm not telling anybody else to do that. But there are companies that I have invested in that it just came down to what I felt. And it turned out right. So Eddie Focal worked out. Everybody that I invested at the time, I invested 50 million, 25% was convertible. The 25% that was converted into equity turned out to be more than what I invested in if I sold immediately after the IPO. So the point what I'm making is every deal different. So I didn't need a valuation for Eddie Focal.
All right. Okay. Thank you. There are a couple questions here. I think they're more for DBJ. I'll probably just take them. What type of grants and support available for small businesses and products? So DBJ has the Big E program that has a number of different products or programs under. The Ignite program is one that supports our idea stage businesses, those who are very early, who have just started to commercialize and sell. We have grants for patents to help businesses protect their intellectual property. We have grants for medium-sized companies, so let's say those that are a little later than early stage, and are still looking to invest in something innovative. We have funding for that. The DBJ also has loan financing that's available. We lend through our approved financial institutions and our microfinance institutions, who are all the credit unions, the commercial banks, investment houses, and we have special lines within those institutions for businesses who are looking to raise. Ricardo had mentioned, he went through a variety of instruments. There was equity first, there was grant funding, there was debt. So again, I would encourage you all to really explore all of those different options. There are questions around a mentorship program, if there can be one that business owners can enroll in getting this level of understanding. I think a couple good suggestions have come out of the discussion related to what the DBJ could look to collaborate on and provide for the market. The valuation one that Kevin mentioned, I think, is a good idea. Having, I guess, maybe it's more workshop type sessions, but something that can educate the entrepreneurs about this conversation much deeper is something that I think we can look into seeing how we can really put that forward. And yeah, I think there's a last question here. How can companies be more scalable? What systems can be implemented, and why is it valuable for companies that want to be investable? I don't know.
Well, scalability determined is linked to market size, right? So that's why you want, the bigger the market is, the more money you can make. The reason why China have the most billionaires is because any idea you come up with, it's very likely that you can find 1 million people to sell to out of 1.5 billion people, right? So that's why scalability is important. How do you become scalable? Well, you have to have an idea that has legs, right? So if your idea is to create a doctor's office, that's not scalable. But if your idea is to create a doctor office that becomes virtual, that may be scalable across Jamaica, then to get it across the world, now you have to have doctors that can operate in various jurisdictions and blah, blah, blah. The point what I'm making is scalability is important because it increases your valuation. And it increases your valuation because you have a bigger market to operate in, so therefore your profitability is much larger, or the opportunity for profit is bigger. That's I don't know any other way.
I mean, tech skills, right?
Technology skills.
Technology skills.
Right.
So just to add to that as well, I've always felt, Sherry, that you have to have a vision of the future. Like, I remember again, just back in 2013, as Kevin you mentioned, I had a scholarship. I was to go overseas. I had to study. But my vision was in fact, I look back at my document and it says to use artificial intelligence to create a personal tutor. This was 2013, close to 10 years before ChatGPT. You have to have and by the way, my mathematical background is what gave me this idea that statistics could be used in some way to predict what people need to learn next. And that vision of the future gave me this idea to create one-on-one, to create a personalized one tutor to one student. They come together and they learn. Can I make that using technology? And if I could do that, my market is 7 billion people in the world. Now you have the older folks may not want to learn anything, so let's restrict that to about 3 billion. And if we could do that successfully, we would have a business. So for me, scalability is obviously the market size, but creating something that people want, people can use, and it's solving a problem in the future. I don't like the no problems. Many people are solving those, right? There are a lot of people in the world solving those. I like the problems that are tomorrow's problems, because COVID happened 7 years before we started. But if we did not start in 2013, we would not have had a product in 2020 that we could serve all the people ready and waiting. COVID happened March. My systems were up and running second week in March, ready for everyone in the Caribbean. Now, we had some challenges in terms of scaling. The platform crashed, but we learned from that. And now we have a solid platform that people depend on every day to learn and to run education systems all across the region.
Yeah, I agree with that. And that's what's so cool about entrepreneurs, right? Is that we see the future before others do. And when I tell people that, with Vehicle, I'm creating the future of car renting in the region, they look at me like, this girl is crazy. There's this car rental company and there's that car. And I said, no problem, but we are creating the future of car renting in the Caribbean. And so for us, we see that vision before others see it, right? And so we work towards building out that vision because we know it can be realized and it can be achieved. And so that's I love entrepreneurship.
So one thing I always say, Chris, I love the excitement and I love the newness. But remember, there are basic things that you can still do. People still have to eat.
Yep.
So we need people to still do that part, right? And one opportunity I'll say to entrepreneurs out there, remember, there is a phenomenon happening in the States and Europe where the baby boomers are retiring. A lot of them don't have nobody to sell them business to.
Good point.
Two of the businesses I have bought, I don't want to say I'm baby boomers. I'm a friend them, but they didn't have anybody to give the business to. So invariably I got it. I was able to buy it. I'm saying that's an opportunity because now they took it to one stage. You as an entrepreneur can take it to the next stage. Remember, McDonald's was started by somebody, but they weren't the one that took it to the next stage. KFC was started by Colonel. It wasn't taken to the next stage by him. Grace was started by Grace and Kennedy. Now it's a different set of people taking it to the next stage. I'm just saying, these guys are doing brilliant. But some of us, we have to provide the lifespan. And some of us have to provide the water. So I'm saying that some of you out there, you can do these things also. Those are opportunities available to you. And that's one of the things that's why the industries I'm rooted in is things that you have to use right now and in the future. You have to eat. And that's why I'm invested in brands that can take Jamaican taste to the world. That's the concept. That's why we buy the businesses that we buy. So that's the only thing I would add to what I'm saying. You have to see the future, but the future is not only AI and new technology. It's also how do you take things that you have now and make it continuously accessible to the rest of the world.
And both are needed,
Right.
by the way.
Right. Excellent. Thank you very much, guys. Before I close, I just want you to let the people know where they can find you, Vehicle, how they can access what you have.
Yeah, sure. So you can follow us on social media. It's Just Vehicle, so it's JUSTVEEKLE. We are on Instagram, Facebook, Twitter, LinkedIn, and YouTube. And Also, you can follow my personal page just to, see my journey in building the future of car renting.
Ricardo?
No, sure. So you can find me by going to our website, One on One LMS. That's ONEONELMS, learningmadesimple.com. And you can find something there that benefits your business, your school, or you as an individual. Again, we're very committed to personalizing education using technology. Very committed to that. Would love to have you on the journey. Thank you. You can also follow me on social media for some of my crazy ideas as well.
And Kevin, somebody here said they want to book a session with you. So if you, I don't know how you want to indicate. Should they route it through us or route it to you? Or,
Yeah, man,
Route
you
it
can,
through
you can,
Roots.
you can do that. But I am not on. I am older than these guys. So I'm not on social media, but my companies are. So you can link me at Roots Investing. That's the handle on Instagram. I'm on LinkedIn, Kevin Donaldson. But Roots Investing is the handle. The website is Roots Investing, and you can link me. Or you can come to Summit tonight or tomorrow, and I'll be there. Because we have games night and we have Summit Fridays, which is a place where we bring people together and ideas germinate and people make money while having fun.
Right. I guess just because Kevin is here, I will say it. I think it's an excellent networking space for entrepreneurs. There are not many spaces in Kingston that are like that facilitate this joint sharing of ideas and vision amongst people. And again, I'm a big advocate for community and building that network. So wherever those spaces are, I will really promote. And I think Summit is definitely one of them that people should check out. I guess I'll close by just saying you guys can follow DBJ at DB Jamaica on Instagram. We have our Let's Dream Big Instagram pages as well, as in Instagram, Facebook, LinkedIn. So you can follow us on that. And you can always visit the website dbankjm.com, as well as Think Biggie, that's thinkbigee.com. And you can get more information about the products and services that DBJ has, which vary from us investing in equity funds to providing loan financing. We have credit guarantees. We have grants and other technical assistance support under the Biggie program and other things. So again, thank you very much, everyone, for joining. And we will continue this conversation through other means. But again, please support all of these entrepreneurs there who are here. Roos is an entrepreneur himself, right? So reach out and seek some advice and see how he can help chart that path for you. And the LMS, the one-on-one, has a great solution that corporates, entrepreneurs can utilize either to display content or to get access to content. And if you need to drive around to all these places, Vico is here. Right? So thank you very much, everyone. And have a good day.
Thank you.
Thank you very much.